we're not using numbers yet, but this is a phenomenal way to look at the direct and indirect method. Cash receipt, this is basically how, this is the step-by-step process and how generally you'll see it on the statement. Cash received from customers, cash paid, blah, 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 all of that there. You get to your ending number. This one, again, pretty straightforward, right? You just look at all the journal entries, you look at the transactions, you look at the balance sheet, and see what is going in and coming out. Indirect method, so record net income, and then you adjust net income for non-cash items, such as depreciation, impairment of goodwill. We saw that, right? Because that's not a real expense. There's no cash going out the door. Step 3, reverse the income statement gain or loss shown on the sale of any asset, right? Because yes, you're going to bring cash in when you sell an asset, but generally speaking, you're going to also recognize a gain or loss for the additional basis of whatever you purchased it for. And the gain or loss is essentially, if you want to think about it in reg and tax terms, what you'll be taxed on. But we don't care about that in this test. We don't care at all. Adjust for changes in current assets and current liabilities, bearing debt, are recorded in financing activities. So right here, current assets increase, we are going to subtract those out. When current assets decrease, we are going to add those back. Similarly, for current liabilities, when they increase, we're going to add them, and then current liabilities decrease, we will subtract them. Think about where the cash is going, right? If a current liability is increasing, that means we are not spending cash for it. And it's definitely an interesting thought process, right? Because it's like, think about current liabilities. Think about your credit card. Just because you swipe your credit card doesn't mean more cash is coming in the door, but the treatment for it is to basically pretend like cash is coming in the door because you didn't have to expend cash for it, right? It's a reversal process. Whereas when current liabilities decrease, how is the only way to really decrease a current liability? Now, you might tell me, Nick, you can refinance it, sure, but don't think about it like that. Think about it. The only way to decrease current liabilities is to pay it out in cash and pay them down. Similarly here, same process for current assets. Well, if current assets increase, that means how do we buy current assets? We generally pay cash for them. We buy something, and then current assets decrease. We are going to add that back. All right, financing activities, investing activities. These are the same no matter what, just kind of on their own on the bottom here. It's the same on both parts. Yeah, it wouldn't change. It might be a little misleading seeing it right here, how this one's under indirect, financing is under direct, but these are their own sort of processes. All right.